Today, my group and I will take you through a comprehensive analysis of the case study of Kerry Group. Kerry Group is an Irish public food company that was founded in 1972. It operates primarily on a B2B business model by providing technology and market insights to its customers, which are businesses that lie in the food and nutrition markets. Its key competitive advantage is that it has a consumer-centric approach to this B2B model. The company is divided into two divisions, Taste and Nutrition and Consumer Foods. It's known for being a globally connected, locally led organisation, and its vision statement is that it strives to be the customer's most valued partner, creating a world of sustainable nutrition.
SWOT analysis. Strengths. Kerry is very customer-centric and it works with customers to innovate and customize products. It also holds a strong technological portfolios with its ingredients and savory tastes as well. It is also a patent holder for technology that removes nitrates from processed meat. Weaknesses. Low spending on research and development, which causes its competitors to get a competitive advantage, is one of the weaknesses of Kerry Groups. It also has a low profit margin, being around 0.9% of Kerry Ingredients Australia compared to all of its competitors. It employs a centralized decision-making approach as well that reduces innovation and increases inefficiency, as it is more time-consuming as well. Opportunities. The company can grow the company's portfolio sustainably, which means through constant innovation of products and not only cost reducing, but taking the right steps to reduce carbon emissions by around 33% by 2030 would impact the customers and the suppliers very positively. A greater presence on e-commerce platform to reach greater audience would also be a very good opportunity for Kerry Groups, for example, being present and active on Instagram, TikToks, and Facebook as well. One of the threats that Kerry Group employs is the fluctuating international trading rules and regulation from each individual governments. Also, the rise of new smaller brands with innovative products and with better promotional strategies. Moreover, the negative impact of COVID-19, which has absolutely taken a toll on each business, and Kerry is no exception. And it took it by being a big hit on sales in China in 2020 as well.
Upon having a closer look at the SWOT analysis, there are many factors that can be interrelated. Luckily, the strengths do outweigh the weaknesses by far. However, there is one standout category. So unfortunately, despite the extensive portfolio of supplying various goods in the nutrition and ingredient market, which is customized to target consumers, as we already know, unfortunately, the company Kerry Group is unable to reach the same impact as other competitive businesses. This is evident through statistics, as it shows that displayed profit margins still sit below the competitors in the market. So there are many comparisons between the threats and opportunities. However, the opportunities are much easier to attain than the threats. So due to mandatory regulations set by the government in regards to trade laws, inevitable changes in exchange rates from different countries, and the significantly high tax rate that we do experience, this threat can be posed as a blockage for the opportunity to expand within the global market that Kerry Group does want to do. Seeing as it's an efficient way for the company to steadily progress, it's unfortunate that this factor is actually out of the company's control, as they do not set the tax rate themselves. Another threat that is worthy of noting is the great online presence of other companies in the market. So in recent years, as we know, digital marketing has definitely taken over and has dominated the industry, and Kerry's group does sit a little behind. However, this is in their control to change by hiring an extensive marketing team and getting a new strategy. This problem can be fixed.
A critical problem of the Kerry Group is their lack of internal research about potential profitable investments beyond Kerry's major operating regions. As seen in the SWOT analysis, Kerry Group operate in a market where competition for market share is high, as the market is highly fragmented. Therefore, it is vital that Kerry Group invest intensive capital, time and energy into market research in order to determine which geographical countries will be the most profitable, successful and advantageous in terms of competition in the long term as opposed to short-term success. Kerry Group has experienced rapid growth over the years. Despite this, a problem Kerry Group currently faces is that as they grow, so is the market in which they operate. Kerry Group holds majority of their investments in developed countries such as the United States, and the United Kingdom, which turn around about 82% of the company's revenue. However, a major problem that Kerry faces in the long term is the growth challenges of developed countries. The case indicated that the growth rate in these markets is only 2 to 3%, and the market is highly fragmented. This has major complications for the long-term success of Kerry, as over time, while sales may grow, revenues will plummet as competition for market share increases. On the other hand, there are major potential growth opportunities in developing countries and markets, even though they are also fragmented, but they are growing at a rate of 28%. As seen in this table, Africa's population is changing at a rate of 2% every 5 years, as opposed to Europe and America's 0.1% average. As a result, the significant change in population can aid in the expansion of Kerry's internal resources and research projects for customers. This will enable Kerry to increase their customer base, which can assist in ensuring that their sustainability strategy is achieved. Furthermore, India is one of the world's fastest growing trillion-dollar economies and is advantageous for Kerry Group. This market can bring opportunities for economic success through cost-saving exports and give Kerry a competitive edge over major industry players, but also smaller emerging brands. However, despite acquiring 24 companies and investing millions in expansion projects since beginning operations, only a small proportion has been invested in companies and projects in these developing countries, therefore preventing the company from effectively seizing market opportunities and mitigating market threats.
The Kerry Group needs to implement internal research and further research into these developing nations. Spending on internal research is highly important, as it will give Kerry Group a greater understanding into the strengths and weaknesses. Demonstrated through the case study was a clear strength of Kerry Group to be able to have positive relations with customers. Furthermore, Kerry Group needs to invest significantly in cultural and social aspects of specific developing markets. These high levels of growth can be made evident through a 58.3% increase in India's disposable income over 10 years. If Kerry Group conducts effective research into behaviours of consumers in these markets, it will significantly contribute to a successful expansion. One of the most effective and simple ways of overcoming Kerry Group's current issue of not utilising developing markets is by increasing capital investment, despite the past 2 years placing significant financial uncertainty. Due to COVID-19, Kerry Group should now consider expanding into developing markets. Kerry Group displayed a significantly large revenue in 2021 of €7.4 billion, and on top of this, Kerry Group recorded an average return on capital of 9.9%, made evident in the previous section of the report. Developing countries are growing at 28%, significantly higher than the US and UK. Furthermore, it is evident that Kerry Group has the financial ability to expand into developing markets, and developing markets have a significantly higher growth rate, posing greater opportunity.
Solution 1 would be to invest large amounts of resource into research and development. The first solution would address the identified problem of a growing market crowded with emerging competition and see benefits in the short term. The effectiveness of research and development will give extensive understanding of potential markets where Kerry Group can effectively capitalize to a discovery of gaps in the market. For example, Kerry Group can discover new technologies and methods to harvest and introduce ingredients obtained through careful research and development, therefore allowing the company to cater to a new market demand with the potential to increase market share. This solution is also highly feasible, as Kerry Group can experiment with highly desired ingredients. However, the company should carefully consider overheads of the introduction of newer ingredients, as competitors may have a significant competitive advantage. Thus, the need to carefully monitor and forecast operations to ensure profitability. Top management also may oppose this solution due to drastically affecting profits in the short term. The possibility of redundancy in R&D is also a major risk to be considered if the adequate markets is not chosen. The second solution would be to invest significant capital into specific developing nations. The second solution would involve an increase in capital investment. This would tackle the issue of emerging brands disrupting profits. The effectiveness of this solution would gain longer-term benefits through investing capital in a booming market. Kerry Group can also ride the market trends for short-term profits and gain longer-term profits through investing in technological advancements through economies of scale for stable profits. The feasibility of this approach in the short term incur heavy initial costs in capital, with the possibility of failure being factored. The excessive risk of investing in a developing market must be considered by management and may be opposed to objecting this solution.
The chosen solution looked at an increase in expenditure into research and development in order to access smaller markets that Kerry Group currently weren't involved in. After the analysis of current geographic locations utilized by Kerry Group's operations, 3 suitable locations for expansion and investment were chosen, including the Middle East, Africa, and South America. This operation will look at expanding upon the currently employed 1,100 research and development workers employed by Kerry Group. The undertaking of research and development to expand into these new markets will be funded internally by Kerry Group themselves. The research and development team and Kerry Group management will work with local authorities to ensure a sustainable development of research facilities and a greater understanding and integration of culture within the introductory period. External parties such as local consultants can be utilized to better develop a quicker understanding of the foreign market to efficiently undertake Kerry Group's vast research and development plans. Kerry Group aims to successfully integrate into these foreign markets through their increased expenditure into research and development to deliver the best, innovative tasting and nutritional solutions for all consumers whilst turning over large profit margins.